All right, let's dive into a strategy that honestly can be an incredibly powerful tool for navigating these crazy volatile markets. But here's the thing, this is not about throwing good money after bad. Not at all. We're talking about a disciplined, totally pre planned approach, a way to buy into a stock you already believe in for the long haul.
You know the feeling, right? We've all been there. You're watching your favorite stock, one you really believe in, and it just drops down 10%. That gut-wrenching moment. The temptation to just panic sell is so real. But hey, so is the opportunity. So what do you do next? Do you buy more? Do you sell? Do you just freeze? Is there a real system here, or are we all just guessing?
Well, this is where the whole idea of averaging comes in. And at its core, it's really just a structured way to manage your entry points into a stock. See, the goal isn't just to get a lower price. It's about reducing the risk of putting all your money in at the absolute worst possible time. So instead of one big all-or-nothing bet, you're making a series of smaller, much more deliberate purchases.
Okay, and this right here is a really crucial distinction to make. On one hand, you've got averaging down. That's the one most people think of. You buy more as the price falls. It's high risk. Then you've got the strategist approach, sometimes called scaling in or averaging up. A lot of pros actually prefer this, adding to a position that's already working. For our purposes today, though, we're going to focus on how to average down the right way, with the discipline of a strategist, not the desperation of a gambler. So, before we even get into the how of averaging down, we have to talk about something way more important, the what. Seriously, none of the fancy techniques we're about to cover will matter one bit if you apply them to the wrong kind of stock. This brings us to the absolute number one foundational rule of this entire strategy. In this quote, just cuts right to the heart of it, doesn't it? Let's be crystal clear. You are not trying to save a sinking ship. You're looking to buy a temporary discount on a world-class cruise liner. Trying to do this with a fundamentally weak company? Well, that's just a recipe for absolute disaster. So what exactly is a high-conviction stock? Well, it's not just a gut feeling. We're talking about the big names, blue chips, leading mid-caps, companies with rock-solid fundamentals, low debt, steady earnings. They're leaders in their sector. They've got great corporate governance. And this is key. You're only even thinking about this when the stock is near a major support level or a clear value zone. Remember, we are not trying to catch a falling knife here.
Okay, so we've covered the what. Now, let's get into the how. I'm going to break this down for you into a simple 3-part blueprint. And the whole point of this is to take emotion completely out of the equation.
It's a really simple 3-step plan. First, size your capital. You have to define your total risk before you even think about buying a single share. Second, set your triggers. Plan the exact entry points based on rules, not feelings. And third, and this might be the most important one of all, plan your exits. You need to know where you're getting out if the whole thing goes south, and you need to know that before you ever get in. All right, let's talk about sizing your capital first. The golden rule of professional risk management is actually pretty simple. Never, ever risk more than, say, 1 to 2% of your total portfolio on any single idea. Why? Because this is your ultimate safety net. It means that if this entire plan just completely blows up, the loss is totally survivable. It's what stops one bad trade from torpedoing your entire account. Next up, setting those entry triggers. So how do you decide when to pull the trigger and buy? Well, you've got a couple of main ways to go about it. You could be systematic, like a dollar cost averaging approach where you invest a fixed amount every month. Or you can use technical levels, pre-planning to buy every time the stock drops, say another 8%. But here's the golden rule, and it is so important. You have to set all of these entry levels before you place that very first trade.
And yeah, this quote from a professional trader just absolutely nails it. This is the difference between the pros and the amateurs. The plan is the plan. Period. If the price doesn't hit your specific, predefined level, you simply don't add. There's no chasing, oh, maybe I'll just get in here. It's just cold, disciplined execution.
Okay, we've talked about what to buy and when to buy it. But now we get to what is, without a doubt, the most critical piece of this entire puzzle. This is the unbreakable safety net. This is what turns this whole thing from a hopeful gamble into a real professional strategy. I really want you to let this one sink in. I'm going to say it again. Averaging without a stop loss is not a strategy. It's gambling. That's it. You absolutely positively must have a point of no return, a price level where you just hold your hands up, admit the idea was wrong, and get out to protect your capital for the next fight.
And I mean, who better to learn this from than a market wizard like Mark Minervini? This quote just perfectly captures the professional mindset. He knows where he's getting out at a loss before he even gets in. Think about that. Your escape plan is designed before the battle even starts. It's the ultimate form of financial self-defense. So, how do you actually define that exit plan? Well, it could be a hard price level on the chart, a line in the sand where the whole thesis is just wrong. Or it could be a max drawdown limit, like, I will not tolerate more than a 15% loss on this total position. And just as important, it could be a fundamental trigger. If the company's health suddenly changes for the worse, maybe debt is piling up or they miss earnings badly, then your whole reason for owning the stock is gone. And if the reason is gone, you should be too.
All right, theory's great, but let's see how this actually works in practice. We've covered the rules, we've covered the risks. Now let's put some numbers on the screen and see exactly how the math of averaging works and why it can be both an amazing tool and a really dangerous trap. Okay, check this out. This table really shows you the magic of the math. So let's say you start by buying 25 shares at $1,000. Then the stock drops to $920 and you buy another 25. Look what happens. Your average cost is already down to $960. It keeps falling. You make your next planned purchase at $850, then your last one at $800. And after all 4 buys, your final average cost, your break-even point, is down at $892.50. Now, think about that. The stock doesn't need to get all the way back to 1,000 for you to make money. It just has to get back above 892. That's the power of this strategy.
But, and this is a big but, it is absolutely a double-edged sword. The upside is obvious, right? You smooth out the bumps and lower your break-even. The downside, though, is just as real. You're committing more and more capital to a position that is actively losing money. And if that stock never recovers, well, your losses are going to be a whole lot bigger than if you'd just taken the first hit. It's a calculated risk. It's not a magic bullet.
And this quote right here is the critical warning. This is the trap. This is what we have to avoid. If you ignore rule number 1, quality stocks only, and you start averaging into a stock that's falling for a very good reason, like its business is fundamentally broken, then every single purchase you make is just digging your hole deeper. You're not executing a strategy. You're just compounding your losses.
So let's put it all together. Before you ever even consider using this strategy, I want you to run through this final checklist. Ask yourself, do I have deep, fundamental conviction in this stock? Is my capital split into at least 3 to 5 planned tranches? Are my entry levels and my non-negotiable stop loss already defined? Is my total risk capped at around 2% of my portfolio? And hey, do I even have a plan to take profits if this thing actually works? If you can't tick every single one of these boxes with a confident yes, then you are not ready to pull the trigger. Simple as that. Which really brings us back to the big question at the heart of all this. Is averaging a sophisticated tool to fix a trade, or is it just a trap for your capital? Is it a way to manage risk and get a better price, or is it a psychological trick we play on ourselves to throw good money after bad? And you know, the answer, as we've seen today, isn't really in the strategy itself. It's in the person who's using it. The one thing that separates the tool from the trap is discipline.